If you're tuning into this video, then you already know that variances suck. Whether you're studying for your college accounting course, you're studying for the CPA exam, or you're just trying to do your job, variances are difficult to understand and they are terrible. But guess what? I'm here to simplify them for you. So let's dive in to all of the different variances that you need to understand. Now, before we do that, please subscribe to our channel and like this video. It goes a long way and it helps us continue to increase the amount of videos that we can share with you. So let's get going. All right, squad, today we're going to talk about variance analysis. And guess what? This is a topic that nobody likes in the CPA exam. And even in the real world, nobody likes variance analysis. Maybe some people, but not the majority. And why is that? Well, first off, it is hard and confusing, but guess what? We're here today to learn a simplified approach to tackling each type of variance analysis that you need to know for the exam. I'm sure you've seen some of the formulas. They're wacky, they're hard to remember. We're going to focus more on a two-step approach for each variance. And then we're going to talk about how to interpret the variance, because if we can get to that level where we can interpret and explain it to somebody else, well, guess what? It makes it a lot easier to remember the formula and how to calculate it. And that's how we best prepare for the CPA exam. So real quick, what is the roadmap for this lecture? Well, we're going to talk about the purpose of variance analysis at a high level. We're going to talk about some key terms that we need to know. And then we're going to actually go through each variance and simulate a process. Right? So we're going to have a bunch of manufacturing variance information. It's going to be a big list. And we're going to learn how to pull out that information for each type of variance that we need to perform. That way we get used to seeing it all in one picture and we know, okay, here's what we are looking for and not necessarily just what's given to us in the question. That's the best way. This will simulate what a company would do at the end of a period to assess their variances. So let's get started. Now, for the purpose of variance analysis, which is most commonly used in the manufacturing industry, well, it's used by companies to assess their actual performance relative to what they had budgeted, right? A company, well, they would budget out the direct materials cost, the direct labor, the manufacturing overhead, as well as some of the selling price and volume as part of their budgeting process. Now, what's the point of a budget if we don't actually compare it to the actuals? So what variance analysis allows us to do is get into the nitty-gritty of what's driving the budget versus actual differences. And the reason is that that's important because different people within the company are responsible for different aspects. But if we only looked at it at a very high level, saying like what drove overall increase in cost of goods sold, well, then we wouldn't know what areas we can improve on and who in the company is responsible for either good performance or poor performance. And so what we do with variance analysis is we drill into the budget versus actual, mainly in the cost of goods sold and the manufacturing process to understand, okay, what went well and what isn't working and where can we improve. So that is the primary purpose of variance analysis. So if we take that mindset as we go through this module thinking, okay, what are we really trying to get out of this variance formula? Who's responsible? And how can they use this information to make better decisions in the future? Well, that is the mindset that we should be applying, and that will make sure that we understand this information in the best way possible. So from a manufacturing cost perspective, there's three main types of variances that we're going to focus on. That's direct material, direct labor, and manufacturing overhead, which will split into both variable and fixed. So those are the main types on the cost side. We'll also touch on the selling price, the sales volume, and the contribution margin, because we also need to understand variances on the revenue side of things, because that impacts profitability as well. Now, for some key terms, there's really two that we need to know. The first is that standards, which are also the same as the budgeted, those are what management expects going into a period. So they would say our standard cost to purchase this is this amount, or our standard direct labor rate per hour is this amount. Now, it can also be budgeted when talking about fixed or variable overhead or budgeted labor costs, right? So get used to seeing these two terms, which are standards and budgeted, used interchangeably. They're both going to be used, and they both mean pretty much the same thing. And we're always going to be comparing them to the actual. So this could be the actual price, it could be the actual direct labor rate, it could be the actual volume, the actual production. So standard versus actual, budgeted versus actual, same exact thing. Now, the other aspect of variances that we're often going to be asked about is whether the variance result is favorable or unfavorable. That's going to be something I don't want you to memorize. Instead, I want to ask yourself, if I was in the position of managing this process, well, based on this result, do I think that's good, meaning it's favorable, or is that bad, meaning it's unfavorable? If we think about it like that, rather than just simply trying to memorize, well, if it increases or it decreases, then it's favorable versus unfavorable. That's one way to do it, but that's one way to also easily get tripped up. So what I'm going to do is really try to help you understand when we have a favorable variance, why is that? And if we have unfavorable variances, why is that as well? That is the thought process, along with the why are we performing this variance, that we can really shape our understanding into something that we can take to exam day and crush this material. As I mentioned, the best way to learn this information is to simulate the actual manufacturing variance analysis process for a company. And this is actually going to be similar to what you would see in a simulation. So this is great because we're going to prepare you for if you got a simulation on variances, it would be similar to this. And the beauty of it is that we're going to touch on each of the different variances that you could be tested on, which are also what you will see in multiple choice questions. So by learning this big picture in the lecture, we're preparing ourselves not only for the simulation, but we're also going to be better prepared for multiple choice questions and filling in that gap so that by the time we're done with multiple choice questions, we're in great shape to tackle simulations. Because if we can tackle a simulation, then we're going to be prepared for just about anything the exam throws at us. So as you can see, there's a lot of information here. We've picked a great company. It's called Hawaii Sun, and they manufacture and sell sunglasses in the great state of Hawaii. Now they give us the following standard and actual information for year 2, and there's a lot of information here. It's the units produced and sold, the selling price per unit, some of the cost of goods sold per unit, the contribution margin, the cost to purchase, some of the materials, the amount or volume of material used in manufacturing, the direct labor hours, the labor rate per hour, and then some variable overhead application rate, variable overhead in total, fixed overhead in total, and then some more fixed overhead application rates. So lots of information, and you can see why if you don't fully understand how this all fits together, it's going to be really hard to pick out the information you need to do for the actual variance calculation. So it's good that we're going to see this all at once and learn, okay, what are we really looking for? And let's go find it. The first type of variances that we're going to focus on relates to direct materials. So there's two main types. That's the direct materials price variance, also known as the direct materials spending. And then we're also going to focus on the direct materials usage variance. Now, obviously, the price variance focuses on the price. Usage variance focuses on the actual usage or efficiency of materials. So let's start with the direct materials price variance. So as we can see, here is the two steps. The first thing we need to do is figure out, okay, what was the actual price per unit of material that we paid? And then what was the standard or the budgeted price that we had set at the beginning of the year? We take that difference, multiply by the actual quantity that was purchased, and that gives us our direct materials price variance. Now, the purchasing manager here is responsible for this variance. They're the one that goes out and says, okay, at the beginning of the year, we believe we can buy it for this price. Were they actually able to find vendors or suppliers that could sell them at a lower or higher price? So if you're the purchasing manager, Would you rather pay more or less for a unit of material? If you pay less, that's good. That means we're going to have a favorable variance. So let's go through and see what the actual result for Hawaii Sun was. So the actual price per unit of direct material, well, that is coming from the cost per unit of material. The actual was $4.75, and they had actually had a standard or budgeted price per unit of $5. So that's actually good because the difference in unit price, well, it's 25 cents. They paid less than they had as the standard, so that's good. And when we multiply it by the actual quantity of materials that was purchased and used in manufacturing, that was 4,000 units, well, that results in a direct materials price variance of $1,000. So the next question we would ask ourselves is, based on this direct materials price variance of 1,000, is that favorable or unfavorable? Well, think back to, what is the goal of the purchasing manager? Well, the goal is for them to acquire materials at the lowest cost possible. So if the actual was lower than the standard or budgeted price by 1,000, once we extrapolate it over the quantity, well, that's a favorable variance of $1,000. And from the purchasing manager's perspective, well, they'll say material costs less than we had budgeted, so that's why it's favorable. So the purchasing manager, they did a good job here. So that is the direct materials price variance. Again, it's also called the direct materials spending because we have to spend money to purchase material. So hopefully that makes sense. We've got one already knocked off here. Now, the other variance related to direct materials is the actual usage. And this is where we're going to focus on the quantity actually used in production versus the standard or budgeted quantity that would have been used. So then what we're going to do is apply the standard cost per unit that we expected to pay, and that will give us our direct materials usage variance. So this is actually going to be the responsibility of the production manager. Right? The goal in the production process is to use as little of material as possible for production. So as we can see, again, here's a two-step approach. As I mentioned, we'll first focus on the quantity because we're talking about usage or efficiency, and then multiply by that standard price, and that will give us the direct materials usage variance. So our actual quantity used in manufacturing was 4,000 units. We had a standard or budgeted amount of 4,750. So we used 750 units less than we had thought. So we multiply that by the standard price, which would be $5 per unit of material, and that results in a direct materials usage variance of 3,750. Now, is it favorable or unfavorable? Well, if you're the production manager, do you want to use less or more quantity to produce the units that were eventually sold? And the goal is to use less, right? So since actual quantity used was less than the standard quantity, that results in a favorable variance of 3,750. So that is how we can interpret the direct materials usage variance. And the question we should be asking ourselves is, were we efficient with production? And in this case, they were more efficient than they had expected to be. The next type of variances relate to direct labor. And these are the employees that are actually working to produce the products that are sold. So similar to the direct materials variance, well, for direct labor, we have the direct labor rate variance, which will focus on the actual labor rate compared to the standard or budgeted rate. And then we're also going to have the direct labor efficiency variance, which says, okay, how efficient were our employees or our labor in manufacturing the units? So starting with the direct labor rate variance. Now this would typically be the responsibility of the HR manager, or it could be the production manager, whoever's in charge of determining what they pay their employees. And really, a variance here could result from just ending up paying more for better labor. So even if you do have a higher labor rate, it's not necessarily like it's a terrible thing because maybe you're more efficient. But anyway, when it comes to just calculating the direct labor rate variance, well, we're going to compare the actual labor rate to the standard labor rate. And that difference in the labor rate is multiplied by actual direct labor hours. Right? So we're comparing the actual versus the standard labor rate and then multiplying by the actual direct labor hours, and that will give us our direct labor rate variance. Now, is it going to be favorable or unfavorable? Well, from the manager's perspective, whether it's the HR manager or the production manager, if we focus specifically on the labor rate, well, the goal would be to pay less, right? Unless the company wants to, have a high rate. But the goal is to pay less compared to what the standard was. Now, for Hawaii Sun, the actual labor rate was $8.50 per hour. They had a standard of $8 per hour. So they paid 50 cents more. Now, that's great for the employees. Maybe they had higher labor costs or they just wanted to pay them more. But when we multiply that in step 2 by the actual direct labor hours of 4,750, well, that results in a direct labor rate variance of 2,375. Now, since we paid more per direct labor hour than we had as a standard or budgeted, that is why it's unfavorable. So for the HR manager or the production manager, they would say, hey, our employees cost more than we had budgeted. But here's why. Now, we don't know why, but they would have to come up with some sort of explanation for this unfavorable variance. Now, the other direct labor variance is the direct labor efficiency variance, sometimes referred to as the direct labor usage variance. And this is all about the actual labor hours compared to the standard labor hours, and then we multiply by the standard direct labor rate. So similar to the other variances, we have our 2 steps. The first thing is to compare the actual volume of labor hours to the standard volume of labor hours. So we had 4,750 actual hours. The standard or budgeted direct labor hours was 5,000. So that means they had a difference in labor hours of 250. So they had 250 less hours than they had budgeted. So that sounds pretty good, right? And then if we multiply that by the standard direct labor rate per hour of $8, well, that results in a direct labor efficiency variance of 2,000. Now, is it favorable or unfavorable? Well, remember, we had actual labor hours that were less than the standard or budget amount, meaning we were more efficient, so that results in a favorable variance. So the production manager might say, hey, our workers were efficient. That training program is paying off. We're seeing a decrease in the actual amount of labor hours needed to produce the units. So that's a favorable variance, and that's a win for the company. Our last type of manufacturing variance relates to manufacturing overhead. And arguably, this is the hardest type of variance to understand, but we'll do our best to simplify it here. So manufacturing overhead can be split into variable, which fluctuates with volume, and then there's fixed, which as it sounds, remains fixed regardless of volume. So what the company can do is go ahead and they budget out variable and fixed overhead, compare it to what the actual variable and fixed overhead was, and that helps them determine how good their budgeting process is. Are they accurate? Are they using the right drivers? Did they over-apply or under-apply overhead? So that's what we're going to try to understand. And one thing that I want to make very clear is that both variable and fixed overhead, it's budgeted based on a standard application rate. Now the company, they must determine what's the best type or driver for the application. Some companies will use labor hours, some companies will use machine hours. Whatever it is, that is how they determine what the budgeted amount of variable and fixed overhead is for a specific period. And then they can come up with the actuals from the financial statements, and that's how we can do the comparison. So we'll dive into the actual details of this as we go through each variance. So let's start with variable manufacturing overhead. So variable manufacturing overhead can be split into variable overhead spending variance, and then we also have the efficiency variance. So one is going to be based on the rate, the other is going to be based on whatever our driver is. Now in this question, based on the information that we're given, well, it says that the variable overhead application rate is based on labor hours. So that's going to be our driver. Now they tell us the variable overhead is $10,000 from a standard perspective. Now one way we could do that, if they did not give us the total, was to say, okay, what's the total labor hours? From a standard perspective, what's the application rate? Well, it's $2 per hour. So 5,000 times $2 per hour. That's how we can get back to the 10,000 standard or budgeted variable overhead. So let's start with the variable overhead spending variance. And this is really, okay, how accurate was our application rate or our spending rate? So the actual variable overhead rate, well, from the information was $2.21. And we already talked about the standard variable overhead rate, which was $2. And remember, if they did not give us that, well, we have other information presumably to calculate that. So that's a difference in the application rate of 21 cents. Now, we're probably going to have some rounding issues, so hang in there. But we're going to actually multiply it by the actual quantity, which in this case, again, what is our driver? Well, that's direct labor hours. That was the driver. So that's 4,750 hours. And that's how they're saying that the variable overhead should be allocated. So when we multiply 21 cents by actual quantity, which was direct labor hours of 4,750, well, that results in a variable overhead spending variance of $1,000. Now that's going to be rounded, but $1,000, let's just say that's the result after doing some rounding. Now the question is, okay, from the production manager's perspective, is that favorable or unfavorable? Well, the actual variable overhead rate was higher than what they had budgeted, meaning that based on the amount of labor hours and the variable overhead that was actually incurred, it was a higher rate. So it's going to be unfavorable. So the production manager would say, okay, our variable overhead rate was higher this period. Maybe we underapplied variable overhead when we did our standard. So we might need to rethink that. But overall, we know it's an unfavorable variance. So now we're going to move on to the variable overhead efficiency variance. So how efficient were we with our variable overhead when it comes to production, right? Were we efficient with our resources this period? That's the question that the production manager is going to be asking themselves based on this type of variance analysis. Now in this case, we're focused on volume or quantity. Similar to our other usage or efficiency variances, we're not as much focused on the rates, but instead we're focused on the driver of volume, which again was labor hours. So the actual direct labor hours was 4,750. The standard was 5,000. Difference there is 250. Now in this case, in step 2, we're multiplying by that standard variable overhead application rate, which was $2. And that results in a variable overhead efficiency variance of $500. Is that favorable or unfavorable? Well, our driver, which was labor hours, was lower. So when we multiplied it by that application rate for variable overhead of $2, well, that means we have a favorable variable overhead efficiency variance of 500. So based on our variable overhead, because our volume, that direct labor hours, was lower, that means we are efficient with our resources this period. So that's how we can interpret the variable overhead efficiency variance. So both types of variable overhead efficiency variances and the spending variance, those are difficult, I understand, but do your best to understand exactly what the goal was here. So now we're going to move on to fixed manufacturing overhead, very similar to variable in the sense that we have a fixed overhead spending variance as well as a fixed overhead volume or efficiency variance. So the question we're asking ourselves here is, how did fixed overhead compare to the budgeted or standard overhead? So starting with the fixed overhead spending variance, this is where we're focused on the actual spend. And this one is actually only one step. And the production manager here is going to assess, okay, were our fixed manufacturing overhead costs higher or lower than we had expected? Well, it tells us the actual fixed overhead was 13,500. The standard or budgeted fixed overhead based on the production
was 13,000, right? So that is a difference of 500. Our actual fixed overhead was higher, so that means it's going to be unfavorable. So that one's fairly straightforward. So the fixed overhead volume variance, well, this is based more on the actual production. And what we're looking here is to compare what the actual applied fixed overhead would have been based on actual units produced based on our standard application rate. Now they give us it's $26, but how else could we get that? Well, they gave us fixed overhead from the standard perspective, which was 13,000, and that was based on 500 units being produced. So if we do the division there, that actually gets us back to the $26 application rate, which is the standard for fixed overhead. Now we multiply that by actual units of production, meaning if we base it on actual units, here's what the fixed overhead should have been, and this is what we would have applied. And so $26 of an application rate times 750 units, that equals applied fixed overhead of 19,500. And that's the actual, right? Now the standard or fixed overhead was 13,000. So our actual applied fixed overhead is $6,500 higher. So now with this result, you're thinking, okay, applied fixed overhead is greater than standard fixed overhead. It must be unfavorable. But the opposite is true. We're just saying that based on actual units produced, the applied fixed overhead is higher than what the standard or budgeted amount was. And that's because volume was higher. So we actually were more efficient this period than we had planned. So this results in a favorable variance. So this one is tricky, but keep that in mind. So we're going to wrap this up by talking about the sales price and sales volume variances. These are a little bit more straightforward and intuitive from my perspective. So starting with the sales price variance, well, the question we should be asking ourselves here is, did we have an actual sales price per unit that was higher or lower than the standard sales price per unit? And based on the data for Hawaii Sun, well, the actual sales price per unit was $17. They had budgeted $15. So that means their sale price was $2 higher. In step 2, we multiply by the actual quantity of 750 units sold. And that means the sales price variance was $1,500. Now the sales team, they're asking ourselves, okay, was that favorable or unfavorable? Well, they sold it for more than they had budgeted. So that's going to be a favorable variance. So you can see how ecstatic the sales team is. They sold the sunglasses for a higher price than they had budgeted. Now, we don't know exactly why, but could have been some great marketing campaigns. Could have been that the channels they sold it through had a higher price. Maybe the discounts, they didn't need to run them this period. A variety of reasons, but make sure you understand the sales price variance and whether it's favorable or unfavorable. So for the second type of sales variance, it relates to the volume. And the question we're trying to ask ourselves there was actual sales volume higher or lower than the budgeted or standard sales volume? Now there's really two different ways we can look at this. We can focus on the actual volume in consideration of the budgeted sale price, or we can actually do it on a contribution profit basis. Right? The idea is that we're trying to understand how a variance in sales volume impacts profitability, right? And sales volume would consist of both the sale price and any variable costs related to that volume. So we'll go through both. So let's start with the sales volume variance, and this is the contribution profit approach. So actual sales volume was 750 units. The standard sales volume was 500 units. That means in step 1, the difference in volume was 250 units higher. Now, standard profitability based on the contribution profit, well, that's based on the selling price minus cost of goods sold per unit. And we can see that the standard was $4 of contribution margin, or the standard profitability per unit, right? And so when we multiply that out, that means the sales volume variance for this method is $1,000. Now, since volume was higher, it's going to be a favorable variance. Now, option number 2 for the sales volume variance, this time we're going to focus on the standard sale price, or the budgeted sale price. So step one is exactly the same. We still have that difference in volume of 250 units. And now we're just going to multiply by that standard sale price per unit of $15. That results in a sales volume variance of 3,750. Obviously, that's favorable. Now you're asking, okay, why wouldn't we choose this one? Well, this one's a little different in that it doesn't factor in cost of goods sold per unit. So that's why it's higher. We're always going to have a bigger volume variance if we take the standard price approach. So be familiar with both. The question will definitely indicate whether they want you to use contribution profit or the standard sales price per unit, but just understand that there are two options here. So now we've gone through all the variances that you need to know for the exam. We focused on how to actually calculate and then interpret and who is responsible for each of these variances. And we took it from a big data set, which is very important because we need to learn how to pull out the information that we need to calculate the variance that we're being asked about. So as you go through the multiple choice questions, some of them will contain just the information that you need. Some of it will contain extra information. You'll have to know what you need. The simulation in this module is also excellent because it's very similar to this. Like I mentioned in the beginning, if we can simulate what this process would look like for a company and who is responsible for interpreting these variances, we're going to be much better prepared to tackle both the multiple choice questions and the simulation on the exam. So go work hard, go tackle those multiple choice questions, watch the explanation videos, and attack the simulation when you feel the time is right. But that is variances. It's one of the more difficult topics on this section of the exam. So if you have to spend some extra time, you're not alone. Just talk yourself through it and make sure you know how to repeat these steps on the exam.